So what we covered last time is actually only the compensation part for gross income. Right? Today, we're going to talk about a lot other things. Like we're going to talk about how you're going to treat the interest, right? So if somebody is earning interest on investments, what is the tax impact of that interest? We're going to talk about dividends. Now, see, in the initial classes, we might be a little slow because we are building up some core concepts. But after I think around 10 classes, and by the time I'll be finishing the individual taxation, and when we go to corporate taxation, you will see that most of the concepts, as far as the core principles of dealing with a certain aspect of taxation is concerned, that I think would be clear by that time, and it will be easier for us to apply these concepts when we're doing corporate taxation. So, right now, when I'm explaining a concept, I am just not limiting myself to what's there in Form 1040. I am more interested in you guys understanding how to think about a particular topic and what is the rationale. Like, if you remember last time we spoke about the insurance, and you will see that in tomorrow's session, we're going to talk about certain kind of life insurance where the company is the beneficiary. So we technically call them company owned life insurance policies. Okay, so what are we going to do today? We're going to talk about a lot of concepts. We're going to discuss interest. We're going to talk about dividends. Again, these are core concepts. The concept that we're going to talk today about dividend, we are going to use it later when you're doing corporate taxation. So today we're going to discuss the concept of how dividend is taxed, and we're going to see how it is in the hands of the individual who is receiving it as a part of gross income. When you do C corp taxation, we're going to look at the same thing, but we're going to deal with it the way a C corp, who is the giver, would be talking about it or dealing with it. Okay. So interest, these are the common ones that we're going to discuss today. We're going to talk about interest. We are going to talk about dividend. We are going to talk about divorce. Now, see, capital gains, I'm just going to touch upon it, but I'm not going to elaborate more on it. And people who are from following UWorld, this is one area that I want you to leave when you're doing gross income, because I don't want to confuse the concepts. Okay. So here, I'm not going to discuss this. I'm just going to give you a very 30,000 feet view of how we'll be doing capital gain, but we are not going to discuss capital gain. Another concept, which is IRA income. Again, I'm not going to discuss this in details here because as a concept, this will be explained in entirety when we're doing adjustments. That means just after this concept. So when we're doing adjustments, we will just cover the portion from the income perspective is also. So here we are going to talk about the deduction, but when you're discussing the concept, you'll be very clear about the IRA income also. So this and this, I'm not going to discuss today. Okay. Then we are going to talk about annuities. Okay. Then we are going to talk about uh, a couple of things. Okay. Let's just get started and let's see how much we are able to cover today. Okay. Let's just so we are going to talk about a lot of these fundamental building blocks. And each one of them, remember, we are talking what we are doing. We are doing 1040 gross income. That means the recipient of the interest, what would be the taxability for that? Okay. And at the background, you should always have Form 1040 and all its schedules so that you exactly know which part we are talking about and how it is going to flow through in Form 1040. Okay. So let's start with interest. Now, see, the best part about interest is that if you look at a very fundamental level, the IRC is very clear. Any kind of interest, if we have not excluded it specifically, then it is taxable. So the general rule is that interest is always a taxable receipt in the hands of the recipient. So general rule is this is something that we're going to talk about later. But right now, this is what you have got to be very clear about. What is it? What is outside the tax purview? Again, the logic is very clear. We would want you. So who is we? We are the IRC. We would want the people of US to invest in certain kind of bonds. Hence, I'm giving them a tax incentive for these bonds. What are these bonds? These are, please understand, these are only state and local government municipal bonds. And with it, we need to be very clear that in the question, wherever they mention federal bonds, that's taxable. So remember, state, local, government, so they can call it state obligation, a municipal obligation. An obligation is like a bond. So any kind of interest that you earn on state, local, municipal bond, obligation, tax free. But if it's a federal bond, if it's an industrial bond, if it's a corporate bond, it will all be taxable. Okay. Another thing is when you again you have bonds on US possession, that means those areas where US have declared possession, but they're still not regarded as any other state in the US, like Guam or Puerto Rico. Even those would be considered non-taxable. One specific kind of bond which will be outside the tax purview is Series EE bonds. We call them education expenses bonds. There is a particular criteria for the interest coming out from these bonds to be tax free. So we are going to talk about it in a little bit more detail, but I don't see them asking you a lot about whether a particular interest is going to be taxable or not. So they will tell you Series EE bonds, and most of the cases, Series EE bonds will be tax free. Okay, so if you look at the details about it, we say that Series EE bonds are used for what? Higher education expenses for whom? For you, for your spouse, and for your dependents. What are the criteria? Now, see, this is a concept that's going to be there in every item of interest, that the person who's a recipient of interest will report it in Form 1040. But even the payer of interest has to give a particular form to the IRC stating that this is the amount of interest income that has been distributed to this particular recipient. So that form is Form 1099 interest form, the INT form. So there are a whole lot of 1099s which has to be given by the payer to the IRC or a copy to the taxpayer stating that this is the amount of interest that has gone to you. And now the IRC knows the perspective from the payer as well as the recipient. So later on, when we do the federal tax procedures, you will see that one very big area is the mismatch of these items. If the payer and the recipient's data do not match, then there will be a first level of mismatch that will be communicated to the taxpayer. Now, these again, I don't want you to go that deep, but just have an idea. Only one thing I want you to remember in this area, which is that these bonds do not cover the room and board expenses. Okay, so general rule, these are those bonds for which you've made an investment for higher education expenses for somebody who's you, your dependent, and the spouse. Also, these are bonds that are bought by somebody who's at least 24 years of age. But the most common item which is tested is it is only for tuition and books. It does not cover room, boarding, meals. All of those expenses are not covered by these bonds. Okay, so general rule, there are three expenses which would be outside the tax net: state local bonds and Series EE bonds. If even these two remember, the others are all taxable. Now, there are a couple of things that I want you to remember because this does not come in our mind when I look at interest. Okay. One is again, it's not a practice which is too much prevalent in India, but in the US, I think the banking sector is really saturated. So you get or you give merchandise to people to open a bank, and again, you have to understand that the interest rates in US are really low. Like in India, even now, like the bank account that we have, it gives us around 7% interest. If there are certain banks who are giving us 7% interest on the bank, just the normal savings interest. Okay. So there's an auto sweep, and we can effectively keep our money in the bank and let it grow to 7%. What is the minimum rate of interest that you get in the US? If anybody knows about it, then I would, or the average rate, people like you and me, when we go and park our money in the bank, what is the rate of interest that you get there? If anybody is aware of it, you can just mention it in the chat panel. 4.5%. Okay. Japan, I think, there was a point when Japan was having negative rates of interest also. Okay. So there is, and so if there's any kind of a merchandise that has been given to you for the sake of opening a bank account, even in those which at fair market value is regarded as interest in the US. Now, this, if you've not heard or this you've not read, it's difficult for you, especially if you're not aware of the US economy, to think of this as interest. Now, two things I would want you to start and remember this very, very well. First is, let's say the tax, you have a refund, and for refund, you have a refund claim from the government. That refund claim is outside the tax purview. But the moment that claim is delayed, and if the government is paying you a tax interest on that refund, but that interest is always taxable, whether it is a federal tax or a state tax. So this is one thing that I want you to remember. So first thing is federal bonds interest, always taxable. Second thing is, whenever there is a delayed refund that is paid to you, then whether it's a state tax or a federal tax, that late payment interest is always taxable. Another thing is, you will see later on that there would be certain kind of annuities and payments where the amount that you're receiving is outside the tax net. But every time a person who's a recipient of money is being given an option that either you can take this amount, so let's say either you can take 1 million right now, or you can take 1.5 million, but it will be spread over, let's say, 10 years, and there would be an interest that would be fetched, loaded on it. So that's called a deferred payout arrangement. So instead of having a right now payout, I could give you a higher payout spread across a number of months. Every time there's a deferred payout, the interest that you get on it, that interest will always be taxable. So maybe the payout is not taxable. Maybe this 1 million will not be taxable. So when you apply this concept later on, when you're doing annuities and the pensions, whenever the payout happens, remember, payout may be tax free, but if there's any interest element because of that deferment in the payment, that is always taxable. Any interest that is given below the market rates of market rates, there's an imputed interest. Again, I don't see a lot of questions coming in this area, but you need to remember that if it's a below market loan, there is an imputed interest that will always be taxable. Okay, if there is an installment sale, so these are the common ones, right? When you do FAR, again, these are not the ones where the calculation will be questioned a lot in your exam. But general rule, if there's a bond amortization, and people who've done FAR would be able to relate to this, then there's a part. So it's basically saying that in very simple language, you have got $80 from the bondholders, you have to pay them $100. So this discount is amortized in the form of interest, which is built up in your P&L account. So even that is going to be taxable as interest. Okay, so general rule, just remember 2 or 3 things. First is if it's a state or a municipal bond interest, it is never going to be taxable. If it's a Series EE or an education expense bond, provided you've spent it for higher education expenses for self, spouse, and dependents, and the amount is towards tuition and books and fees, not for room and board, that interest will be outside the tax net. A couple of things in taxable interest: federal bonds always taxable, deferred payout interest always taxable, refund interest always taxable. Okay, so we did. Okay, sorry guys. Okay, let's solve this quickly together. Okay, 1 second. E is education expenses bonds, Shashankar. Okay, education expenses bonds. So there are a lot of so if you recall, already we have spoken about education assistance. So you will see throughout the entire section of individual taxation, you will see there will be a lot of focus on education, a lot of focus on retirement. Okay, so this is again, education expenses was one. 1 second, guys. Was one area. Today, what we did was education expenses bonds. So if you're investing in education expenses bonds, the interest element will be tax-free. So these were the interest that has been earned in a particular year. Now see, the moment you see federal treasury bill, you know that will be taxable. So the word is federal. If it is federal, it will be taxable. Okay? Municipal bonds, tax-free, not within the tax purview. Interest earned on state tax refund. Again, it's a refund interest, so it's going to be taxable. Interest earned on Series EE savings bonds used to help pay for room and board. Room and board is disallowed, so that means it's again going to be taxable. So the out of 5,600, if you add this is the amount that's going to be taxable. Is it clear to everybody? I don't see interest getting more complicated than this. Okay, just remember the couple of things that we spoke about. If that you can retain and be very alert, guys. If they say corporate bonds, if they say treasury bills, if they say federal bonds, but remember, if they say federal taxes, the refund on that is going to be always taxable. Okay. Now, uh, now let's look at the second concept, which is dividend. Okay, the best way to deal with dividend, again, this is a very, very important concept, guys, because later on when we are going to discuss C corporation taxation, we are going to make tremendous use of this concept. And I'm not going to repeat this concept then again. Okay. There are 2 or 3 people who formed a company. And okay, let's think about a big company now, guys. Okay. People who've done far will be able to relate to it easier. But still, it's a concept which is not very difficult to buy. Okay. Now, see, let's assume that, and think of bigger companies here. So let's assume I am investing in HUL. And HUL, let's take for very simplicity purposes, I have put $100 and I've bought a couple of shares of HUL. Now this 100, so when I make that investment, what is the journal entry that I'll be passing in my books? When I'm making that investment, I am buying, uh, I'm buying shares. So that will call that there'll be a debit, which is investment in shares account debit. And I am paying money to buy the shares. So I'm going to debit the asset, which is going to reflect in my balance sheet, and I'm going to credit the bank. Now imagine if the company is growing big, and if the company is investing your money, and if the company is generating income, and if the company is distributing that income to you. What is the journal entry that you'll pass? Let's say the company declared $10 as dividend, and that money comes to me. So if you do FAR, you will see that this is the first kind of investment where we are not bothered with how much money the company is making, and we are so small in relation to the decision making in the company that it really doesn't matter how much is the company earning and how much is the company giving. We are only interested in how much money am I getting. So what is a journal entry, guys? I'll debit bank because this is the amount of dividend that I get. How much is it? $10. And I will credit what? I will credit dividend income. Okay. Now, essentially visualize what are we trying to do here? We are trying to figure out if you give me a P&L and if you are a taxpayer and if I am your tax consultant, I'm simply going to figure out your P&L and figure out what are those items that has to be offered to taxation. So I look at your P&L, I see this dividend income and I'll offer it to taxation. But what is the underlying principle behind a dividend income to be taxable? The underlying principle is the dividend income has to come out of earnings and profits of a company. What do you mean by that? It means the $100 that you gave. Like you, there are, let's say, 100 people who invested $100 each in the company. And when I have that outlay that is at the disposal of the company went ahead and the company invested this 10,000 and the company must have generated, let's say, 2,000 over and above. This is the profit. And the company is now giving you part of that profit. It's the concept of dividend. And legally, only that part of profits that are coming out or that part of dividends that are coming out of the retained earnings or fresh earnings of the company, only that part can be categorized as dividend income. So that means now what would happen if I look at it very closely? I have a balance sheet that is showing me an investment of 100 and I have a P&L for a particular year which will show me a dividend income of 10 which eventually will be closed in my equity, right? So my equity balance which was 100 had retained earnings, this became 110 and there was another asset called bank or cash which increased by 10. That was the entire flow that has happened. I imagine if this was not HUL, this was a startup, and the startup did really well in the first 2 years. But then the startup started having issues. And when it started having issues, it did not want the investors to know that the money is becoming a problem. So, what did the company do? Now it had $12,000 at their disposal, out of which, let's say they had already spent 1,000 and they're left with 1,000. So now they have 11,000. So, what they did? They again gave a next round of dividend because probably that was a pitch that we're a company who's going to give you regular dividends. Now they gave another set of $10 as dividend to you. You will again pass a journal entry, the same journal entry, bank account debit to dividend income. Why? Because another 1,000 is coming again from what? From the earnings and profits of the company. Now when I do that, now this amount remains at 100 But this becomes 20 and this also becomes 20. Now the company has hit the roadblock and the company's money has all been exhausted, which is earnings and profits. And the balance 10,000 is lying with the company. But the company still wants to give a feeling that the company is doing very well. So what does the company do? The company declares a third set of dividend in the third year. And that dividend is actually, where is the company going to give you that dividend? Can you think about it? Where is the company going to give you that dividend? There is no amount now. Now the company has invested all its earnings and profits. So basically, whatever money has been contributed by the people, which either might have remained as cash, is now going back to you, or the company might be disposing of the assets, selling it, something they're doing, but they're returning that money back to you. When they're returning that money to you, now the IRS says that this money is now not coming from earnings and profits of the company. So remember, guys, in the real world, the money would come and it would be disguised as dividend by the companies. It is for the taxpayers to understand that that money is actually a return of capital. So IRS, you will see that later on in the 1099 interest also, they will make the people who are paying it categorize and give it to you. This is this, this is this, this is this. Okay? So here now we have not see, it's not 1099 interest, it's 1099 dividend, DIV account. Now the journal entry that will be passed will be what, guys? I'm receiving cash, so I'll still debit bank 10, but now this is not dividend. Yes, very good. So in this case, I'm going to credit the investment. So basically, I'm going to treat it as if the investment that I gave to the company of 100, that investment is coming back to me. Now this in the tax language is called return of capital. Again, this is called a liquidating dividend. So from the company's perspective, it's a liquidating dividend. Why? Because you're liquidating the stake that the people have in the company. So the first fundamental principle is any money that flows from earnings and profits would be regarded as dividend and will be taxable in the hands of the recipient as dividend income. Any money which is a return of capital, that means the company has exhausted all its accumulated and current earnings and profits and it is still giving you dividends. That's called return of capital, bank account debit, investment account credit. Assume this happens and the company pays you 90 again. So bank account got debited, your investments which were at 100 has got completely wiped out. That means what had happened? This became 120 and the investment completely went out. The investment has been completely vanished. Imagine that means the company had 10,000, it earned 2,000, it again gave away all of that too, it was left with 10. Again, it completely went bust. So what happened? It started with 10, earned 2, gave back 2, gave back 10, came down to 0. So this is called earnings and profits and the money. So this is from the company's perspective. This is from the investor's perspective. The investor would be calling it a dividend income, paying tax on it. For the next $10,000, the investor will be calling it. So this is a liquidating dividend for the company and a return of capital for the investor. This is non-taxable. It will simply bring down the value of the investment. But even beyond that, if the company continues to give you money. Now, can anybody think of a situation where is the money? Where is the money coming to the company? The company has exhausted all of 10. Still, the company is now giving you dividend. Can anybody tell me? There's only one scenario in which it is possible. Can anybody tell me what can be that possible scenario? People gave me 10. I exhausted all of 10. Still, I have money to pay you. In what scenario is it possible? I had put in that money of $10,000. I put it in buying some kind of a fixed asset. The value has shot up, which is typically real estate or anything which is having a long land. Let's say I've got in some land, the value was low, but now the land value has gone up. Only in those situations can you still go ahead and declare dividend, even though all your investments and all your earnings and profits have become zero. Now, if that happens, then the IRS comes up and says, see, ultimately this was capital gain, right? Now, probably the company is going bust and the company is trying to pay that penny or not pay that cut to the government, but to declare it as dividend and pay it to the company's shareholders. Hence, we say that since this amount is anyways on account of sale of capital asset, I will tax it in the hands of the shareholders as capital gains. Now, in the US, capital gains have lower rate of interest than regular ordinary income. And we'll see how it works. So remember, if it's a normal dividend, it is taxed as ordinary income in the hands of the shareholders. That means there we are having a tax impact of at the max 37%. You will see if it's capital gain, I give you a lower tax impact. Okay. So from here, we build up a theory. And what is that theory? Please remember this concept, guys. The journal entries work wonders in this area. But what is the theory telling you? This is what the theory tells you, that any income which is made out of earnings and profits of the company, RE here stands for retained earning, may be current or may be accumulated. That part of income is taxed at normal rates. It is an ordinary income in the hands of the recipient, and it will be taxed as dividend income in the hands of the recipient. After exhausting all the current and past earnings and profits, if the company still goes ahead and distributes a dividend, it is categorized as return of capital until the extent of investment by the investor. It will not result in any tax impact in the hands of the recipient because there will be a cash which will be debited and the investment which will be credited. And I think I made a small error here. And in the end, even despite that, if the company continues to give you dividend, it is deemed a capital gain distribution by the company and it is taxed at capital gains rate in the hands of the recipient. Is this clear? Anybody, any questions? Is the concept clear? See, we are going to use a lot of journal entries when we are doing C Corps, when we're doing S Corps, because there it is so much easier to visualize a P&L. General rule, any amount that the company pays you in cash, or even if the company is paying you in property in terms of deemed fair market value, it will be regarded as dividend. Now, see, this is a concept which is again coming to India. In India, dividend income was tax free for a very, very long time. And then we started introducing a bit of double taxation in India, but only for certain people who've got a lot of exposure in the stock market, right? In the US, we say that if it's a qualified dividend income, what's a qualified dividend income? Now, there are certain rules. You will see that these income or this amount of dividend must be distributed by companies which are domestic corporations or foreign corporations who have met with certain criteria to be given that exemption. So, in case if there is a particular dividend, now again, I have not seen them asking you a lot on typically what is a qualified dividend, what is not. General rule, if it's a qualified dividend, you have lower capital gain tax rate. Why? Because there it will be taxed as LTCG rates. So remember, if it's a normal dividend, it has to be ordinary income. But if that normal dividend is coming out from a domestic corporation or qualified foreign corporation and the holding period thresholds have been maintained by the investor, that means I am substantiating to the IRS that I did not buy this dividend just to flip to the share and then earn profit. So it's not that the company declared dividend. I bought the shares so that my name comes in the category of people who are deserving to get the dividend. I get the dividend and then I sold the shares. I don't want those kind of investors. But if you've been able to retain the shares in a 120-day window, 60 days before the declaration and 60 days after the declaration, I would call you a serious investor. Okay, will you be questioned on this? I don't see any question coming. Typically, in categorizing a dividend as qualified dividend, know the rules, right? So, general rule, if it's a qualified dividend, I enjoy a lower capital gain tax rate and not ordinary income tax rates of 37%. Okay. Also, if there are, let's say, higher salaries being paid to you, right? So you made a small company. It's called a C corp, but it's run by only, let's say, 10 people. And what you did, instead of declaring something as dividend, you are just paying yourselves a higher salary. Even that is constructive dividends. Okay. General rule, what is not taxable or what is tax free? As we said, it's either a return of capital or liquidating dividend. We know this. Stock split, right? Instead of saying that I have one share of $10, I'm now splitting it into 10 shares of $1. That's again tax free. Bonus dividends, right? Bonus dividends, again, there are certain concepts here. I don't think need to go a lot into details because that's generally not tested in the CP exam. But whenever there is a bonus dividend declared, in India, we could just call it as bonus shares, right? I have 10 shares, you give me 2 every 10. So that becomes that extra 2 that I get is a stock dividend. Now, general rule, no cash is flowing in and there's no extra gain to you except in the form of increased price, which also you can't get today, you'll get in due course of time. So, general rule, we say stock dividend receipt is a non-taxable event unless the company came and told you that, see, either you can get further stock at reduced price, let's say, or you can just get cash. So, remember, when that even option is given to you, and irrespective of whether you've exercised that option or not, even if the company gave you that option, I will still make that dividend a taxable dividend. Why? Because for the IRS now it's possible to put a value to that dividend and tax it. So if the company comes up and say either you can take 2 extra shares or you can get $200, and it's irrelevant whether the taxpayer chose 2 extra shares. If that option was also given to the shareholder, we would still go ahead, we will put and we will offer that $200 to taxation. Why? Because there was a possibility to put a dollar value to that dividend that you received. Okay, so general rule, if it's a stock dividend, it is not taxable unless an option was given to you by the company whereby you could have got cash in lieu of dividends. But remember, the exercise of the option by the shareholder was not mandatory. Okay, life insurance dividend, I have insurance, I'm paying for that, and you're giving me dividend. So a part of it that reflects my capital investment in you or my premium payments to you will be tax-free return of capital. This we're going to do a little bit more in details when you're going to do S corporation. You know, S corps and partnerships are flow through entities in the US. That means, instead of what we are doing right now, that you receive dividend and you offer it for taxation. In case of partnership as an S corps, you offer the money to taxation even before the money is distributed to you, right? So it's like saying I'm an S corp, you pay me 100, I generated 20 as a return, and probably I paid you only 10. So when I offer taxation as a flow through member, when I offer my money for taxation, I will put this 20 only as income and I will offer it for taxation. That means I have already taxed a higher sum or equivalent sum before the actual process of distribution happens. Hence, when the distribution happens, I am not going to pay tax again. Okay, but this concept, I'm going to park it right now. Let's go to S Corps. There, I think this will give you bigger clarity. So these are typical non-taxable, any kind of a receipt from the company, which may or may not be disguised as dividend, but IRC is going to treat it like a tax-free dividend. Okay. As I told you, the third layer is capital gain distribution. In the case when you've already exhausted your entire earnings, profits, current, past, and the investment. Then also, if the company goes ahead and declares dividends, that's a capital gain distribution, and that will be taxed at capital gain rates in the hands of the company. Okay, this is just for your information, so you get an idea of how much is the tax rate for LTCG. Because I think whenever, see, this is how I built up a concept when I was a student, and I feel this really helps. Whenever you get a new, try to build it as a foundation so that every time later you use it, you are not repeating that and you are going to build up on your concepts, right? So when I say LTCG rates are lower, at the max, the rate is 20%. At the minimum, it is 0%. And for most people in the middle age income bracket, it is 15%. So if you park it against an ordinary set of income, your highest tax rate is 37%. If it's taxed as an LTCG, it is taxed at 20%. And if you are not in an extremely high bracket, it may even be as low as 15%. And if you're on the lower side of the bracket of income, it is even 0%. So for an individual in the US, it makes a lot of sense to push certain things as LTCG rather than ordinary income. In other words, it is better to hold on to a property for a little longer and have a lower tax outflow than holding it on a shorter period of time and categorizing that tax as a short term capital gain. Okay, so more on this when we're doing capital gain and property taxation. But right now, just register it. If it's a dividend coming from a US corporation, and if you are able to substantiate that you're a serious investor, then you can attract a lower tax rates for those qualifying dividends. This is what I told you. Generally, payers of dividends, they'll send a form called Form 1099 DI. We see all of these forms are available on the irs.gov website. If you are a little more curious, you can download it. But remember, this happens only after you've done your basic homework. All of this is research, which is good, but not at the expense of your basic deliverables. Okay? So, this people who are paying, they will have to tell you if it's an ordinary dividend, if it's a qualified dividend. Okay, look at this question. Emily bought 50 shares of stock in year one for $500. In year two, she received a return of capital of $100. She received an additional return of capital of $50 in year three. What must Emily report as long term capital gain on her tax return for year three? It is still a return of capital. That means if I look at my example that I gave you, it has not gone below that $10,000 threshold. So it was not, so if I look at my example, this was 2K, so this was 12K, this was 10K, this is 0K. All the return of capital is happening in this zone. So we've still not crossed this zone and went below it to be taxed capital gain rates. Hence, in year three, there will be no capital gain for this taxpayer. Now, see, the concepts are as simple as this, guys. Okay, the only way by which people or AICPA might trick you is they'll give you a wrong year here. They'll try to confuse you by stating so. So be very careful when you read the question. CPA exams are not difficult. It's very simple exam, but keep your concepts and base very clear. You should be able to navigate very freely between topics. So when I give you dividends here, you should be able to later on when I'll teach you the dividend deduction and stuff in corporates, you should be able to link all of these. If you are able to do that and keep your mind really alert in the exam so that if the tricks and the traps that they set for you, if you're able to recognize that, I don't think the regulation can be any more difficult than this. Now I'm going to give you another concept. Okay. So we did interest, we did dividend. So we've done portfolio income. Okay. Now we're going to talk about something called so this is local and state taxes. This is the term that we generally use, but this concept is applicable for every scenario in which you would have generated a tax benefit in 1 year and later on you get a refund. So let's say I've taken a tax deduction in any year and in future I get a refund of that. So let's say, so one of the examples or one of the common areas which are tested in CPAs, they'll tell you a state and a local tax refund. So what happens? State, local taxes, you and not federal, because federal tax there is no deduction that you get in the entire 1040. Why? Because federal tax is considered as a personal expense. But if it's a state or a local tax, later on you will see that there's something called, you remember itemized deduction, guys? We start with gross income, then we have the first layer, which is adjustments, then you arrive at adjusted gross income. From there, you can either take standard deduction or a group of all those small fishes called itemized deduction, pitch it against standard deduction, whichever is higher you take. Then you deduct qualified business income deduction and you arrive at your taxable income. So that means, it's either a standard deduction or a big bundle of all the small items and we pitch it against the standard deduction. So one of the items here is state on local taxes. Okay. So imagine in a scenario where in any year I have actually itemized. That means what I did, I took all of these bundle of things in an itemized deduction. One of those items was total local taxes. I put that and I did not take standard deduction. I went ahead and I chose the itemized deduction. That means have reduced my taxes in year one. So what happened in year one? I had paid some state and local taxes. I used the provisions given in itemized deduction. It resulted in a lower tax impact. How? Because the deductions were higher than the regular standard deductions. So I claimed that deduction and then I went ahead and filed and I paid my taxes. That means the taxes that I paid was lower than what I would have paid had I taken the standard deduction. Now, let's say in year two, a part of those state taxes came back to you as refund. It means what? There was an expense which was eligible for a lawful deduction. I used that deduction and I reduced my taxes. That means I took a tax benefit. In future, when that amount, that means that the expense has been refunded to me. That means typically this deduction that I took is now wrong. So now the IRS is very clear. IRS says if you have attained or if you have achieved a benefit in any year, which is later on negated, then the income that you get in subsequent years, that you have to offer it for taxation. But remember, only till the extent of the benefit that you receive. Okay, this is very logical also, right? I use a deduction, I got some tax benefit, but in future I got the refund. So I need to put it to taxation now if I got an increased tax benefit. Now I'll tell you the theory behind it, but first I want you to look at the question. Okay, sorry. Let's look at this question first, okay? Taxpayer who files single elected to itemize the deductions, claiming $10,000 of state income taxes paid. So the word is state. If it's a state income tax, I get it as a deduction in itemized deduction and some interest for which there was a total itemized deduction of 4,900. Now we will not cover itemized deduction, but so long it makes it apparent that I got a tax benefit or I got an itemized deduction of 4,900. So this was my total itemized deduction on account of two figures. One was tax and the other was interest. And I'm assuming both of it would be allowed as a deduction and as an itemized deduction. In the next year, I got a state tax refund of $2,000. What should be the tax treatment of the refund in the hands of the recipient, which is the taxpayer? And they have also given you the value of your standard deduction. For the year 2023, you are eligible to deduct $13,850 as standard deduction. How much would be offered for taxation in the current year on account of a state tax refund? I could have got 13,850 anyways. That means the extra benefit that I got was only between 14,900 and 13,850. So at the max, I can roll back only 1050. I cannot roll back 2000 because even if I would not have got this money, let's say if I would not have got this money, I would have reported 12,900. If I would have reported 12,900, I would not have itemized. I could have just taken a standard deduction. So the extra benefit that I got was only of 1050 and only that benefit can be rolled out. Is this clear to everybody, guys? And this is so logical, right? Why should I be taxing full 2000? As a taxpayer, why should you cheat me? I got an extra benefit. Only whatever benefit I got extra, you roll it back. I cannot be asked to pay tax on full 2000. The benefit was only to the tune of total of itemized deduction versus standard deduction. Is this clear? Yeah. So this concept, this is just an example, but this concept, every time there is a rollback of any tax benefit, you will have to use this concept. So in this example, it was itemized versus standard deduction. If it was it would be an item which was direct deduction, then you will take the full amount which will be taxable to you. So this is the most complicated it can get. It can never get complicated more than this. Okay. So if you look at the theory now, sorry, I did this, right? If you look at the theory now, so generally, if you use the itemized deduction in the prior year, so in case if you're standardizing, then it makes no difference whether you get a refund, whether you don't get a refund. You're not going to have any tax impact. Why? Because I did not get any extra benefit. But the moment I get a refund, it is going to be taxable to the extent of extra benefit that you are receiving. And if you have used the standard deduction, see Form 10 Easy has been eradicated now. If you have used the standard deduction, then the refund will anyways never be taxable. Okay. So remember, if you've itemized, then you need to understand whether a tax benefit was received in any prior years. If you did not receive any tax benefit, that means if you would have standardized, you would not have received any tax benefit. In that case, the refund is not taxable. But if you've received a benefit, you're going to roll that benefit back. But remember, only till the extent of delta, the extra benefit that you received in any prior years. Okay? Where do you show this? Again, you don't need to mug up these form names. I will give it to you for a first couple of them so that you get that idea that every time you get a receipt, the person who is paying that money to you also has to give a similar form to the IRS stating that this has been the amount that has gone back to the taxpayer. So generally what happens, in the US, people say that even if you have a problem, you first pay the taxes and then file for a refund claim. Okay, so later on when you go for the judicial processes and then the procedures also, we will see how in a lot of cases it's better to first pay the taxes and then ask for the refund claim. So you paid the full amount and then you put on a notice to the tax department saying that I don't think this is the right amount, and you claim the refund. That refund order got passed in your favor this year. Is this clear? Everybody? Can we move ahead? So we've done interest, we've done dividends, we've done the refund of state and local taxes. Please remember, not federal. So always federal income tax, no deduction. Federal bonds, no deduction. If anything is pan-US, no deduction. Okay, so remember that thing very well in your mind. Okay, always remember, even if it's a refund, the refund will be tax-free probably, but the interest element of that refund will always be taxable. So tie it up with the interest thing. Okay, so stitch the concepts together, guys. You will never get regulation wrong. But if you do things in isolation, then you will get confused when I mix everything up and I give you a simulator. Okay, so remember, let's say if I would have, let's say in the same question, I would have not itemized, I would have taken a standard deduction. So if there's a standard deduction, then anyways the refund will not be taxable. I will ignore it. But if they tell me the refund came in with $200 of interest, then that $200 will be taxable in my hands. Okay? Yeah, there's a history behind this. Okay? Now see, alimony payments, again, it's a big thing in the US. In India, see, the society is such that we were very averse to divorce. And even at this point of time, we have such a social norm here that if anybody is asking for a prenup before the marriage, it is either the girl will be labeled as a vamp and the boy, I don't know what's going to happen, because in India, still we do not have that equality that you can think of. But imagine a scenario in the US where the society is much more open to divorce. Okay, so what used to happen earlier? Let's first understand that, and then we'll come up and think what happened with the Tax Cut and Jobs Act. Okay, so what used to happen earlier was this: that let's say there are two parties, they're living together, and then they opt for a divorce, and there's a legal separation that's happening. So this is, let's say A and B spouses are divorced. And let's say B has a child. Okay. And B wants to, and both of them have a child, have a child, but then one of the spouses takes a custody of the child post marriage, and the person uh, who's not the custodial parent for the child, parent is giving a particular support, and let's say that is a child support. Okay, so there are three different things that could have happened in the case of a divorce agreement prior to the Tax Cut and Jobs Act. What were the three things? The first thing was a simple money that would be for B's support. So because of the fact that A and B are separated, A is a person who has agreed to go ahead and still provide some financial support to B. Now this financial support is typically termed as alimony payments. Then the next thing that could happen is A could also come up and say that there's some amount of money that I'm going to give for a child support. So till the time the child does not attain, let's say 18 years of age, or till the time the child is a student, and I'm going to give this percent of my money there. So some amount of money could be for B support, some amount of money could be for the support of the child. And sometimes there used to be something called property settlement. Right? Think about, the big marriages that we're speaking about. Think about Johnny Depp, Amber Heard. Think about all of those people, right? Now we have a scenario when there are two people, be equally influential, and they are getting into a very high profile divorce agreement. Now, in that case, what is happening? There is child support, there is spouse support, and there is a property settlement. Now, what used to happen before 31st December 2018? I'm imagining all the divorce agreements. So that divorce decree. So most important thing is that divorce legal paperwork that was filed. So if the divorce decree was signed before 31st December 2018, that means before the Tax Cut and Jobs Act became effective, I will, one second, just let me look at the date clearly once because I don't want to feed you something which is incorrect. One second, it is 31st December 2018. Okay. So before that, what used to happen was this. What used to happen was we used to tell that, see, if it is alimony, okay, if it is alimony, then I'm not going to treat it like a child support or like a property settlement, because alimony is actually the person who's giving is a cash that is given to the person who's receiving. So for alimony, we used to put it in a separate category. We used to call alimony as alimony, and we used to think that child support and property settlement is actually for the upkeep. Without that, it will be hardship because the recipient spouse and the child will not be able to survive without this. So that was the logic that we had. So what we did, we put these two in one bucket. Somehow, alimony, we could not treat it similarly. So what we used to say is this. We used to say that, see, if it is an alimony, I'm going to treat it like an income of the recipient, and I'm going to treat it like a deduction for the payer. Now, what do you mean by that? It means the money that is moving away from A to B, that money I will not tax in A's hand. So it was not non-taxable in A's hand. So in the hands of the payer spouse, it was a non-taxable amount. And we used to tax it in the hands of the recipient, saying that, see, you earned this money because you received the alimony. But for child support and property settlement, we used to say that, see, these are the basics without which probably we would not survive. So what we would say is, we would say that, see, if any money is for child support or if there's any settlement for property, I am not going to treat it like an income for the recipient. I would still continue to tax these two in the hands of the payer. So there was no deduction that the payer would get for child support and property settlement. And so if there's no deduction, that means it is taxable in the hands of the payer, and it was not regarded as income in the hands of the recipient. So there would be no taxation in the hands of the recipient. Is this clear? That means we used to say that alimony is deduction for the payer. So don't think of it like deduction or no deduction. Think of it as who's paying tax. Who's paying tax? The person who's paying alimony will not pay tax. The person who's receiving alimony will pay tax. But the person who's paying child support and property settlement will continue to pay tax on these two because we don't want a lot of hardship in the hands of the recipient. So the recipient spouse will not pay anything for the child support and property settlement. Now, this was before the Tax Cut and Jobs Act. But when the Tax Cut and Jobs Act came, then the environment changed. We are talking about how high profile uh, stuff. So we are not going to think about divorce as something which is only for people in the higher income bracket. We are thinking of divorce for everybody. And if that be the situation, you don't know who are the people who would really suffer. So it's like saying if there's somebody who's really in a bad spot, and if you're making that person, let's say if that person is surviving only on alimony, then if that person is receiving 1,000, you are cutting off 30% straight away from their hands, right? So we followed one same concept. We forgot the difference. The differences between alimony and child support and property settlement was totally done away with. And post 31st December 2018, any new agreement that would be signed, we said that we put everything in the same bundle. What is the same bundle? We said in case of alimony, child support, property, anything that happens, the person who is paying will pay tax, the person who is receiving will not pay tax. That means it is not a deduction for the payer spouse and it is not an income for the recipient spouse. So if you look at the law, it's very clear. I am not. So remember, one thing is very important here. We are not bothered when is the receipt happening. We are bothered when was the agreement signed. That's the most important thing. We are not interested in knowing what time or in which year are you receiving the money. I'm only interested in knowing when is the agreement being signed, right? Because it's such a big amount, right? That we cannot think of going retrospectively and changing the taxation impacts there, because the parties who got into these agreements had a different tax angle in their mind when they signed those agreements. So I'm not disturbing those. Only the fresh agreements that are being signed after the Tax Cut and Jobs Act, it means after 1st January 2019 and after that, only for those we are going to follow the new rules. So anything that was signed before 31st December 2018, we would not tax it in the hands of the recipient, and we would tax it in the hands of the we would tax it in the hands of the recipient and not in the hands of the payer. But then, if the divorce agreement was executed after 2018, we would say that let it just be taxable in the hands of the payer and not in the hands of the recipient. For child support and for property settlement, anyways, we were following the earlier approach. So, what we did, now we have put everything under the same heading. Nothing is taxable in the hands of the recipient, and everything is taxable in the hands of the payer. Okay? What's a divorce property settlement? Generally, whenever there's a property settlement that's happening during divorce, we are not going to treat it. So remember the base concept that we said. Are you going to treat something as a taxable event or a non-taxable event? If it's a property settlement, it's a not taxable event. It is not regarded as deemed sale, and there will be no capital gain tax on it. Okay. What is regarded as child support? Now, see, again, this is very important. What is important is what is written in the agreement. Okay. So, if it is said, okay, I'll show you a question and then this concept will become clearer. But what I'm trying to tell you is, see, we don't bother how much is child support, how much is spousal support in the real world. In the real world, what is happening, I don't bother. When I think about the taxation, I will go back to what is there in your divorce decree. So if your divorce decree asked for, let's say, $10,000 to be paid for alimony, and out of this, if they said that out of this, I will discontinue $1,000 when the child reaches 18 years of age. Either they say that, or they clearly say that $1,000 out of 10,000 is for child support. So either they will mention child support, or they will say the amount will be reduced, or the amount is towards the child attaining 18 years of age. After that, will discontinue. So if they say that, so out of this, 9 becomes child support, and 9 becomes spousal support, and 1 becomes child support. So in future, let's say this guy gave you only 3,000 out of 10,000. What will I do? I will go back to the agreement. The agreement says 1,000 is for child support. So I will first take out 1,000 for child support, and then the balance 2,000, I will call it spousal support. Okay. Now, why is it important? What if this guy is supposed to pay some money to the child's tuition center or child's school or college automatically? If that happens, then let's say they tell you that out of this 3,000, only 500 was given for child support and the balance 2,500 was given for spousal support. Even if they tell you something like this, how will be the tax impact? The tax impact would only be as per the divorce decree. First, I will recover full child support and then only it will go to spousal support, irrespective of what is happening in the real year. In the ground level, what is actually the amount, we are not going to match it. No matching. What's written in the divorce decree, go by that. First for child support and then for spousal support. Now understand that this delta is applicable only in this particular scenario. Because the moment it is after 31st December, we don't bother whether it is child or spousal. We are not going to tax anything in the hands of the recipient spouse. Okay, just look at a question. I think this will make it very clear. Okay, there are some laws here. Just go through it once. This is just for your information. I don't think they're ever going to ask you all of these things. Okay, so if something has to be deemed alimony, cannot be from the same household, just go through it once. It's a very self-explanatory thing. Look at this question. What amount of these payments should be reported as income in Martha's income tax return for the year 2023? So the first thing that I'm going to look at is the year of divorce decree. Okay. Joseph and Martha were divorced in 2017. Stop. I know it is before. If it is before, I know alimony and child support has to be separated. For alimony, I'm going to tax it in Martha's hand. So I'm going to treat it like this. If this is M and this is J, for alimony, I'm going to tax it in Martha's hand. For child support and for property settlement, I'm going to tax it in Joseph's hand. Okay. Now just fill in the blanks, right? The divorce decree provides that Joseph pay alimony of 10,000 per year to be reduced by 20% in 5 years on their child's 18th birthday. That means I know that for child support it is 2,000 and for alimony it is 8,000. I know this now. During 2023, that means during the current year, Joseph paid $7,000. Joseph paid $7,000 directly to Martha. So out of this 8,000, we actually went up and paid 7,000 and 3,000 was paid to Spring College. That means I paid 10, but instead of splitting it as 2 and 8, I split it as 3 and 7. Okay. So can Martha reduce her income and say that I will pay tax on only 7 and not on 8? The answer is no. What we'll do is we'll go by the divorce decree. What is the decree telling you? The decree is saying the first 2,000 will be for child support and the balance 8,000 will be alimony. So the entire 8,000 will be charged in Martha's hand as divorce settlement. Okay, this was the most complicated that this particular thing could have got. See, if they are giving you a question on divorce, just be very mindful of when the agreement was signed. See, we are not bothered about what was the money that was paid and in which year. We are interested in when the divorce agreement was signed. Now we look at the next question. Now, see, this I am not going to delve a lot on the items of income and the items of deduction because that we are going to do when we are going to do C corporation. Okay. So I'm going to just give you a really quick overview. But there is one tax that's really relevant when we are doing business income. So see, what are we doing? When I'm saying business income, guys, what I'm actually referring to, can anybody tell me? I'm referring to Form 1040 schedule. I'm actually referring to Form 1040 Schedule C. Is it clear? So what are we doing? We're doing individual taxation. So in India also, guys, if I'm running my own business, I have my ITR 2 or ITR 1 so ITR 2 that I'll be filing. And then if my business is not giving me an income which is beyond a particular threshold, there will be a schedule on profits and gains from business and profession that I will have to file up and the profits, net profits from that will be clubbed with my ordinary incomes and I will be paying tax on it, right? Same thing applies in the US. If somebody is having a sole proprietorship or if somebody filed a one person company but did not file an extra paperwork to the extent that now tax is just treating you like a sole proprietorship. In both the cases, if you are generating business income, then that amount of income minus the expenses is booked as either a business income or a business loss. So Schedule C, which is one part of 1040, is for all of those taxpayers who are either operating a sole proprietorship, disregarded entity, one person company who has not filed an extra paperwork declaring to the world or declaring to the ministry of, so in India we have Ministry of Corporate Affairs, there we have a similar counterpart whereby we are saying that we want to be treated like a C corp. So we have not done that. If that happens, then whatever, so this is the most important thing, guys, whatever happens, I'm going to treat it like a self employment. I'm not going to treat it like, okay, I think this will be incorrect to mention. I'll tell you why is it incorrect later. Okay, but right now just think about it. If I'm running my own business and if I'm generating money from it, even you will see later when I'm running a partnership business, there'll be some money that I'll make as a partner and that money will be subjected to self-employment taxes. That's not there if I'm doing an S corp. So that's the reason why an S corp is a more preferred form of business taxation compared to partnership. Because a member of a part or a partner of a partnership will be paying two taxes on the net income, the self-employment tax and the federal income tax. But the member of an S corp will not pay the self-employment tax. Okay, this is confusing. So I'm repeating what I'm saying. If I am generating money from my own business, I am not only paying something which is called the federal income tax. That is what we are doing, right? When I calculate taxable amount and apply the tax slabs, I add the other taxes, I reduce the credits and I reduce the payments. What I get is a additional federal tax to be paid or the federal refund to be received. Now that is one tax that we'll calculate. But apart from that, if I'm running my own business, there is a schedule called Schedule SE, self-employment. Now in schedule, so typically visualize it like this. I am having a master form 1040. I am visualizing it as different pages of an Excel file. There will be a schedule C and there will be a schedule SE. So here I will have some gross income. From the gross income, I will have some deductions. And then from here, I will either have profit or I will have a loss. If there is a profit, that profit will go and it will hit your gross income of 1040, whereby I'll say it's a schedule C income. Okay, so this, let's say that amount was 100. Okay, out of this 100, I will take, so this is what? This is my earnings from self employment. Okay, but here there is this concept of FICA taxes. What is a FICA tax? That entire concept is a little confusing if you've not had clarity on it. So my suggestion is please go through. This portion here is very, very important. Go through it a little slowly because you're going to also use this concept later when we're doing a C corporation taxation, because I am explaining you the entire concept of FICA taxes. That's what is important. That's what is something that I'm going to spend time today. What are the deductions? What are the item of gross income? This part we are going to do later when we are going to do C Corp. There you will see a lot of the business income. What is business income? What is not business income? What are business deductions? That concept is similar. We are going to do this in greater detail when we are going to do C corporation taxation. Okay, what we are going to spend time right now is how do you arrive at the earnings? And once you know the earnings, will I pay the self-employment tax of the full amount of 100? Or is it something else? And if it is something else, why is it something else? Now see, house is there in every book. But I want you guys to understand why it is happening. Why are we giving you a self-employment tax? Why, if that money is not on 100, what is that amount on? And is there anything else related to it that I need to be considering? So here there is one element called X. We will decode X. Here we are going to talk about what is the amount with which we are going to pay the self. So we will see that it is not 100. It is some other amount. Then we are going to talk about what is that self-employment tax that we're talking about. So this is the concept that I want you to run you through in today's session. Okay. So what would happen? And this is something that I've already discussed with you earlier, that when I'm discussing Schedule C, it is only a sole proprietorship or a disregard. That means it has to be some earned income from a business that you're operating for profit, a business or a profession. Apart from that, if you're getting any kind of a passive income or a passive loss, like real estate, royalties, S corps, partnerships, all of that I will not report on Schedule C. I will report all of that on Schedule E. So it's very, very important for you to understand that Schedule C is only for your business. Schedule E is for other passive sources of income like rent, royalties, and so on. We did rent. Oh no, we'll be doing rent today. So how do you calculate it? So this is what I've already spoken in the last class. You remember, if there's a business, if there's a property that I have, and if I'm running it like a service apartment, providing food and clothing, no, sorry, providing food and let's say old age house. I'm running a service apartment as old age house service apartment. So I'm giving these people a person who's going to help them take their medicines on time, take them to the doctor. All of that is a business that I'm running. That's not passive income. Okay. But if I'm only maintaining that property, paying for light, heat, cleaning areas, cleaning the trash, or all of that, that's not any service that I'm giving over and above the maintenance of the property. So all of that would still be a Schedule C income. But the moment I'm running that entire property like a business, then that amount will go to Schedule C, not in Schedule E. So how do you calculate? You take all your business income, you reduce the deduction for the expenses that you're allowed, you generate a profit or a loss. If it's a profit, there are two taxes that you pay on that. The federal income tax that you're talking about is Form 1040, the tax that you'll get. But then this is the tax that we're going to discuss, which is self-employment tax. So this tax is the topic for today's discussion. Okay. So at a very, very rudimentary level, I'm not going to discuss this a lot. But let's say we have gross income. Generally, whatever amount, either in cash or in terms of property that you're receiving, even if there's a debt that I've taken from somebody and I don't need to repay that debt again, we still call it a cancellation of debt income. So I take the money from you, cash, property, and the foregoing of debt. Everything becomes my business income. From there, I'm going to reduce the expenses. Typically, most ordinary and necessary expenses that I incur in order to run my business are allowed as a deduction. But there are some very explicit exclusions that the IRS has stated because these were the areas where people were grossly misusing the business, the Schedule C form of business, like entertainment. People were going on their personal holidays and personal dinner, and then they were putting all of that expense as a business expense. So they clearly came up and said, for meals, this is so. When you go and read about the business expenses in C Corporation, we're going to do this in a lot of detail then. Then we're going to see how much is a restriction for meals, for travel, for entertainment. I've done away. Entire entertainment expense has been disallowed. So this is something that I've just given as a cursory thing for you right now, but we are going to deliberate more on this when we're doing C corporation. So what are the general things that are taxable, that are deductible? Deductible means not taxable, right? We have cost of goods sold, salaries, commission, local taxes, state taxes. Please remember, no federal taxes. The business tax that you pay on the federal income or the federal income tax is for the sole proprietor, not for the business. So hence, not federal tax. Business meal standard, I have given you a 50% deduction. I don't bother whether it is personal, business. Business meal, only 50%, not more than that. Depreciation, interest expenses, if you're an accrual basis taxpayers, then the bad debt that you get. Not a cash basis because there the amount would not have been booked as an income in the first place itself. What are not allowed, strictly disallowed is entertainment. Earlier they used to allow this, but a lot of misuse, they've discontinued it. Okay. Any amount of salary that is paid to the sole proprietor is not allowed as a deduction. Federal income tax, so these are big ticket items, guys. Okay, the first three I want you to register. Why now? Because for sole proprietor, this is different than for a C Corp. So that's the reason I want you to understand it here. If you're a sole proprietor and you're withdrawing any part of the money, that is not salaries, even though you may call it as salary, but it is actually drawings. Any amount that you're spending on the personal use of things like automobile, meal, travel, and all of that, it will always be taxable. Okay. Even health insurance premium, you will see if you're a sole proprietor, I give you that deduction, but I give you that deduction on your itemized deduction for your personal expenses, not in your Schedule C. Okay. So one kind of question that will be typically asked in this area is they'll give you an expense. That expense may be a deductible expense for form 1040. Let's say on form 1040, that expense is an allowable deduction, but not on Schedule C. So if you go to business income or a business deduction, that is not a business deduction. So be very careful about the question. Is it asking you that this is a deduction for form 1040? Or is the call of the question that is it a deduction for form Schedule C, form 1040? If it is not a deduction on Schedule C, the answer will be different. So there may be some deductions which are allowed, not on Schedule C. So look for the call of the question really well. Okay, so anything which is personal in nature will not go on Schedule C. It is only the business amounts that will be taxable or deductible on Schedule C. So be mindful about those kind of questions. So what do you have? We have a net business income. If there is a net business income, remember there will be two taxes. One would be federal income tax and the other will be self-employment tax. Okay, self-employment tax is shown on Schedule SE. And if it's a loss, it's a net business loss. Again, this is something that I'm not going to deliberate a lot, but again, this was something that has undergone a change. Earlier, I'm talking about before Tax Cut and Jobs Act, they used to allow you to carry back this business loss 2 years and carry it forward for 20 years. So what is carry back? Carry back means if there's a loss, I can go and file a revised return for the last 2 years and I can claim a refund on account of the loss that I generated this year. They're slowly doing away with the refund, with the carry back, because that's very cumbersome for any. I think it's a very bad provision, also, frankly. Going back, asking somebody to restate the tax returns that has already been submitted, it's not a very good idea. So they are slowly doing away with the carry back provisions. Okay, so now what they say is this again. I'm not going to ask you to do it completely right now, but this is a stage when they've introduced you the concept. I'll give you what is the concept and then we'll move ahead. But we're not going to deliberate much on this right now. Now, what they say is this: see, whenever there's a business loss, first of all, don't carry it back. Prohibited. What do you do? In future, you can knock it off, but only against 80% of your income. So basically, it means is, let's say in first year, I had a loss of $100. In the next year, I had a profit of, let's say, $70. And again, in the third year, I have a profit of $150. So, can I offset $70 as brought forward losses and pay zero tax in year one? And then I can go to the third year, I take 30 as a brought forward loss, and then I pay tax on only 120. Can I do that? IRS says no, you can't do that. At the most, you can set off loss to the extent of 8% of your taxable income of the current year. That means even if you have a huge amount of losses that you can set off in the future years, I'm not allowing you to do that. In the max, you will be allowed 80% of 70, that is 56. There's a money of 40. You knock off, you pay tax on $14. And then the balance 44 that you have, again, you go to the next year and ask yourself, what is the maximum that you can set off as a loss? It is 80% of $150, which is 120. So I know I have 44. I will knock off full 44 and then I will pay tax on the balance amount. Means now the provision for a business loss is carry back prohibited, carry forward for unlimited number of years, but only to the extent of 80% of the income of any particular year, not thereafter. There are a lot of topics in gross income, and the most important part is a lot of those areas we are going to touch again when you are going to do either a C Corp or other forms of taxation. So I don't want at this stage to to rush things up only to cover business income. If there are so what we did in dividends today, we'll use later also. Okay, what we did in capital gains, we're going to use this concept later also. Okay, so be very, very alert to this because we are going to again come back to this when we are doing other taxes. Okay. Now, this is a very important slide for the simple reason that you don't see it anywhere. People are referring to this in every content. I don't know. Becca doesn't have it for sure. Even at this stage, I don't see UL providing it. Lime does not provide it. So most of them, they don't comprehensively give you this idea, but they keep on using the terms FICA and they keep on using the terms employment taxes. So my suggestion is at this stage, do everything very well. Because once this is clear, crystal clear in your mind, and later on when we're doing self-employment taxes, IRA, you will be able to understand the differences in these terms. Okay. Now see, what happens is throughout the working life of an individual, it's like in India, we have this concept of Provident Fund, right? What is Provident Fund? When I'm working, so let's say I get into the workforce at the age of 25. Okay. And let's say my working age is 60 years. So what I'm going to do over the next 35 years, I'm going to work. And the idea is the government wants us to save some money for our retirement. Because I don't want you to become old and penniless. Because you stop earning when you become old. So what do you do? For the next 35 years, whatever you are earning, let's say for very simple purposes, let's say I'm earning $100. What is the provident fund rate right now in India, guys? 14%. 13. What is the rate now? The provident fund deduction rates in India, I think it's some 14, 15, right? At some point of time when we were working or when I had an active salary income, it was 8%, 12% now. Okay. So what would happen? So let's say I am earning some money. Let's say I'm earning $100 every. I'm just making it very simple right now. So I want you to feel the figures. Okay. And for simplicity, let's say the provident fund amount was 10%. So what would happen? Every year, my employer will deduct $10 and pay me 90. And then let's say there's a provident fund in my name, in the name of a taxpayer. This 10 will come from the employee's share. And then the employer will give a matching contribution of $10. So in a year, I have $20 that gets posted in my provident fund account. This will continue for 35 years. The money will build up into a corpus. It will attract interest. And when the money flows back to me, I will get that as is it a taxable or a non-taxable amount, guys, in India? Provident fund, if you withdraw before a particular age, will always be taxable. That's the reason people say you should not withdraw the provident fund amount. You should roll it till the extent, because the moment you withdraw that money before a particular age, the entire amount will become taxable in your hands. So if you earn, let's say 10,000, you'll be able to enjoy only 7,000 of it, because the balance 30% you have to pay to the government in taxation. The same concept, we are going to apply it for FICA. So FICA is a short form for Federal Insurance Contributions Act. So the same concept you're going to use if I am working as an employee to somebody, right? So the employer will have to deduct FICA taxes and pay the remaining amount to the employee. And then that employer will have a own self contribution that he will have to make, which is matching to the employee. So FICA taxes is actually Federal Insurance Contributions Act that is applicable for an employer-employee relationship. So it's a tax which is employer-employee. Now the funny part of a sole proprietor is he is both the employer and the employee. So what we are learning here is the application of FICA for a sole proprietor. But for that, I want you to understand FICA in entirety, so that later on when we have to do FICA, we will not do it, because we have already done it before. Okay? So how does it work in the US? So these are the rules for FICA. Okay. The first tax that you pay is social security tax. And why is it paid? Because you want to build up a program whereby you can be given money for your old age. Let's say you have there is some problem and because of which you've survived, but your earning ability is significantly reduced, or there's a disability insurance. In order to provide for these throughout the working life of healthy individuals, we collect tax from them in the form of social security tax, in which the employee has to pay tax the rate of 6.2%, and the employer also has to match it to the extent of $1,60,000. So for the employer, the moment the amount of money which is paid to the individuals exceed 1,60,200, I will stop my contribution beyond 6.2%. I will not do that. There is a per wage limit. The moment the annual wage limit exceeds 160,200, I will not do a matching contribution thereupon. This. So my total amount which goes to FICA for an individual becomes 12.5%. 6.2% in the employee's percentage, 6.2% in the employer's percentage. But remember, there's a thing of 160,200. So the total 12.4 goes and sits in your name in these FICA taxes. And then we have this hospital insurance. That's also termed as a Medicare tax. So what you impose is the Medicare tax, and the benefit that you give is the hospital insurance for people who are above 65 years of age. The money that has to go to Medicare has no upper limit. That means whatever is the amount of money, the moment you are paying a wage to an employee, as an employer, you have to deduct 1.45% for the employee, and you have to match up an equivalent 1.45% and then put it in the Medicare tax account. In other words, if I look at it, I have a total 7.65% that is deducted from the employee. I put a matching 7.65% from my hand, and the total 15.3% of taxes gets in the name of FICA and gets deposited. Please understand that there is a maximum. This is an indexed figure. Every year this changes. In the year 2023, it is 160,200. For Medicare, there is no limit. That means essentially, if the wage is between 0 to 160,200, the tax which is applicable is 15.3%. But the moment it crosses beyond 160, 200, then the rate becomes, essentially, the rate will become only 1.45 to 1 point. That means only 2.9% because the first level will get vanished. Only for those people who have their wages in excess of $200,000 for single filers and in excess of 250 for joint filers, we have an additional Medicare tax of 0.9%, which is only given by the employee and not by the employer. So this is an extra figure only applicable for employees, not for employer. Is the structure clear to everybody? So we have 15.3%, assuming that the wage figure was less than 160, 200. At the max, it is 15.3%. And the moment it touches to $200,000 and beyond, then we have an extra 0.9%. That means at the max, it can be 16.2%. Okay, so this is the structure of the FICA taxes. Essentially, the employer pays half, the employees pays half. Now, tell me something, guys. Now tell me something. Let's say I'm the employee. So if I would have, so first understand what happens in the real world. Okay. So imagine what would happen if it's an employer-employee thing. Okay. Let's say it was not sole proprietorship. What would happen? The employer, and let's put some figures into this. See, think about a normal scenario. Okay, what would happen in the normal scenario? This is the employer, this is the employee, and put some figures into it. Then this will become so much more easier for you. Okay, so let's say I have to pay $100 to you as a deduction, as a salary. So what entry I will pass? So out of this $100, let's say the employment taxes I have to pay was 7%. I'm simplifying it. Okay, so what I will do when I pay you salary, there will be some FICA taxes payable and there will be some bank figure, right? Can anybody quickly tell me what will be the figures that I will be putting up here? What will be the journal entry? Can you tell me? $100 is the salary. I have to make FICA contributions. Fill up the figures for the salary account debit to FICA taxes payable credit to bank. Just tell me what figures I'll put. My total salary hit will not be 100. It will be 107. Is it clear to everybody? How much tax deduction I will get as an employer? How much tax deduction I will get as an employer? I will get a total tax deduction of 107. Isn't it? That means 100 that I pay for salary, and another 7 that I will pay as my portion, or I will call this 7 as employer's portion of FICA taxes. Isn't it? Everybody? Is this clear? As an employer, I get 100. And on 100, I will get another $7 as my portion of FICA taxes. Is this clear to everybody? Now think. This is a good question. Think. If I am the employer and if I am the employee, I am the employer and I am the employee, and I have to calculate how much would be my FICA taxes. Okay? How much will be my FICA taxes? Okay? Now, let's put some figures into it. Let's say as a sole proprietor, I earned $1,000. Okay? And I know now that for FICA, I have to pay 15.3% as FICA taxes. Can anybody quickly tell me what will be my total? So I club the employer and the employee portion, and instead of calling it FICA taxes, I say it is as self-employment tax. Is this clear, guys? Everybody? I don't call it FICA anymore. I will club the employee and the employer portion. I will club it together and I will call it self-employment taxes. Okay. Now for simplicity, I'm removing this as 15.3% and I'm continuing with my previous example of 14% because I want you to see the delta. Can you tell me when I calculate my FICA taxes or my self-employment taxes, what will be the figure? What will be the figure? So they say that when I'm going to calculate my self-employment taxes, I'm going to calculate it on my net earnings from self-employment. My total earnings from self-employment is 1,000. how much would be my self-employment tax? Is it making sense, guys? That means what they're trying to tell you is this. You go to Schedule C. Okay. Now here nobody is paying you that $100, right? Nobody is, I'm not an employee and you're not paying me wages. So I cannot pick up that 160, 200. I have to calculate that 160, 200. How do I do that? They say go to your Schedule C. There I'm going to get some gross income. From the gross income, I will reduce my deductions. From the deductions, I will get my profit. Let's say that profit is $1,000. They say you get the income, the gross earnings from sole proprietorship from Schedule C. And then you come to Schedule SE in order to calculate your FICA taxes. My question is, do I calculate FICA taxes on full 1000? Do you think that is correct? If no, where is the delta? So they tell you you have to calculate your net earnings from self-employment and then take both the employer and the employee's share, which is 15.3%, then pay tax on it. But always understand that when I was an employer, what I did, I took my full earnings, assume the same thing. In the earlier case also, let's assume the employer earned $1,000. Now, from this $1,000, the employer was able to deduct not only the salary but also the employer's contribution to FICA taxes, isn't it? So, what do we now say? We say you take your earnings from self employment and you deduct the employer's portion from it, whatever you get. So, I deduct 7% of the employer's portion from it. What I get from the balance, yeah, from the balance, I will calculate. So, what I'm doing, I'm taking my total earnings from self employment and I'm multiplying it by 92.3%. Why? Because the employer's portion of 35 something, 100 minus 7.65% would go to my net earnings from self employment. And on that, I'm going to calculate both the employer and the employee's share of 15.3%. So what we're doing, I'm repeating. I will take my total Schedule C earnings. I will multiply it by 92.35% because that's the figure after considering the deduction, business deduction of 1/2 of self-employment taxes. On the balance, I am going to ask you to pay both the employer and the employee's share. So that will come to 15.3%. Now, how will I report it? When I report my gross income on 1040, first I will have the gross income. And on the gross income, I will report full 1000. And then there is an adjustment. You remember the first layer of deduction above the line was adjustment. I will take whatever is the figure that I get here. I will take half of that figure. Wait, Jashankar, it is not done. I'm just explaining. I will take half of that figure, and that is 1/2 of self-employment taxes paid, and that half I will report here as an adjustment. So the employer portion that I'm getting as a deduction, I will not minus it from the gross income. I will show the full figure here. I will minus it as an adjustment and I'm going to show the net figure that will flow to my taxable income. I'm repeating. I take my total earnings from sole proprietorship. I will take only 92.35% of that earning because I should ideally have calculated my taxes only on the residual after getting a business deduction. On the balance, I will calculate both the employers and the employees' share. Whatever will come is my total self-employment taxes. Half of that I will get as a deduction on the adjustment figure, which is I think schedule adjustment comes in schedule 1 or 2. We'll just check it up. I think it is schedule 1 only. One is adjustment and other income. So schedule 1 I will show adjustment and then it will flow to the uh, flow to the main income. What I will do is just hang on, guys. Let's take a question from here. When you have words, when you have figures here, it will make it easier for you to understand the concept. Look at this question. Chris is required to pay self-employment tax based on net profits of his Schedule C business. For purposes of this task, assume that Chris had a net profit of $105,000 from business for year 3 and $10,000 of Section 1231 gain. Okay, so I have my business income of 10,000, of 105,000, and I have my capital gains of 10,000. Also assume that the maximum net earnings from self-employment for the social security tax 160 for year 3. So you know that the maximum would be 160, 200. Your is way less than that. So you will get the full 15.3% deduction. Also assume that your social security rate is 6.2 into 2, which is 12.4%, and your Medicare is 1.45 into 2. So your total becomes 15.3%. And now they're asking you to calculate all of this. Okay? I know it looks a little strange, but think about it. Out of all the income, so there are two incomes that they have stated, right? Schedule C and Schedule D. This is Schedule D and this is Schedule C. Tell me what amount of income will be my total amount of self-employment income. What is the first figure? Guys, I want you to participate. Okay? I need to know what you're thinking. What is the figure that I'll put here? Will it be 1,05,000? Will it be 1,15,000? Yes? What is the total amount that I generated and I earned from a business activity this year? What is that figure? So it is $1,05,000. Out of this, how much would be my net earnings from self-employment? I will take this and I will multiply it by 92.35%, which is the employer portion getting deducted. Because whatever I earned, that extra 7 I would have got as a deduction, right? Because I'm the employer and the employee. So I get that extra amount as a deduction. And it is the only figure is net earnings from self-employment on which I will calculate the self-employment taxes. So my net earnings becomes, yes, 96,968. On this, I will pay both the employers and the employees portion of social security taxes, which is 15.3%. So that becomes my self-employment tax, 14,836. And 1/2 of it will be the adjustment for my deduction purposes. That is the employer's half actually. So it is 14,836 divided by 2, which is 7,418. Now there's another way of looking at it. So how do you calculate this figure? Why is it 92.35? How do you calculate this? See, if you look at it, have you seen that part in India? We used to do this for bonus calculations. When we started with, commission and bonus calculation, what is the amount after calculating the bonus? So we used to take 10% bonus, 10 by 110 into the figure. If you take a similar concept, you will get this even here. See, 1 lakh, so 7.65, right? Divided by 107.65 into 105,000 is somewhere it will give you the figure which is close to 7,418. Have you guys tried it? So they tell you when you calculate self-employment, FICA taxes, it is, so this you're going to learn when you're going to do C corporation. They will say it is the amount to be calculated after considering the deduction. So it will come to a similar figure. If you're not able to understand this, park this figure. Is the other concept clear? This is a difficult concept and it is not something which is cohesively written anywhere, guys. So you need to be very clear with this because you're going to do this again when you're going to do FICA taxes. You're going to do this again when you're going to do C corporation taxes. I have tried to really break it down into smaller parts and let you explain the full thing. Was I successful? I'm not too sure. Are you? This is a critical area, guys, and people get a lot of. So this is actually a sim, okay? So you may get a sim like this. If you're very clear with your concept, it shouldn't be a problem. So how will they complicate it? They'll complicate it saying that this amount was way higher. If it is more than 1,60,200, you have to calculate 6.2 on only 1,60,200, and the balance will have only 1.9%. They can complicate it any further by, but again, these are not kind of questions which are generally questioned in CPA exam. Frankly, they don't complicate this portion that much because this concept itself is a little difficult. So in MCQs, you should be prepared to answer questions on 160-200 threshold and the additional Medicare threshold. Now, from this year, this concept has become more important because FICA taxes have been given more credence than in the earlier years. Is it clear?